Somewhere in Lagos, Karachi, Mumbai, or Sao Paulo, a business owner is about to open an invoice from their freight forwarder, and the number will be higher than last quarter again. They'll assume it's inflation, or fuel prices, or the exchange rate. In some cases, it will be none of those things. It will be because the port, the toll road, or the airport they depend on has quietly changed hands. Not stolen, not seized, sold through a concession contract that was signed, gazetted, and reported, but that almost nobody in that owner's supply chain ever read. This video is not about politics. It's about a $106 trillion global investment wave and what happens to your operating costs when it reaches the port down the road from your warehouse. If you run a business that depends on a road, a port, a rail line, or an airport in Nigeria, India, Pakistan, or Brazil, this is the most important 20 minutes you'll spend this month. Because the honest truth is this: infrastructure that used to be a fixed cost is becoming a variable one, and most business owners are the last to find out. By the end of this video, you'll know exactly which corridors are being concessioned right now, who the new owners are, and what questions to ask your logistics partner this week. Here's the mechanism in plain terms before we go country by country. McKinsey's 2026 Global Infrastructure Report estimates the world needs $106 trillion in new and upgraded infrastructure through 2040. Roads, ports, power, water, and digital systems combined. Governments in developing economies, and increasingly in wealthy ones too, cannot fund that gap from their own budgets. So they lease out operating rights, a port terminal, a stretch of highway, an airport concourse, usually for 25, 40, or even 99 years at a time. In 2025 alone, private investors raised a record $200 billion specifically to buy into infrastructure like this, breaking the previous record set in 2022. The clearest proof of how seriously global capital takes this shift. In January 2024, BlackRock, the world's largest asset manager with nearly $10 trillion under management, acquired Global Infrastructure Partners for $12.5 billion. Bloomberg called it BlackRock's largest acquisition in over a decade. That single firm now holds stakes in airports, ports, pipelines, and utilities across more than 100 countries. This isn't a conspiracy. It's disclosed in stock exchange filings, government gazettes, and press releases. The problem is distribution, not secrecy. Nobody is mailing business owners a memo that says, "Your export costs are about to change." You have to go looking for it. So let's go looking, starting with the 4 markets where this matters most for you right now: Nigeria, India, Pakistan, and Brazil. Let's start in Nigeria, because the numbers here are the starkest proof of what happens when infrastructure ownership and infrastructure investment fall out of sync. Nigeria's ports handle over 80% of the country's international trade, and almost all of it funnels through Lagos. According to 2024 data from Nigeria's National Bureau of Statistics, the Apapa Port Complex alone processed over 90% of the nation's exports. The remaining ports, Calabar, Warri, Port Harcourt, On, together handled less than 5% of exports combined. Calabar, Nigeria's first deep-sea port, is now what one port manager publicly called a ghost facility. Not a single container vessel docked there for 25 straight years. The African Center for Supply Chain estimates Nigeria loses about $14.2 billion every year to bottlenecks at seaports like Apapa and Tinkan Island. The Lagos Chamber of Commerce and Industry separately estimates Nigerian businesses lose roughly 2.5 trillion naira a year to port and infrastructure inefficiency. As of 2025, cargo was sitting in Nigerian ports for an average of 18 to 21 days, nearly 5 times the global average of 4 days. According to Nigeria's own Shippers Council, port charges in Nigeria now run 30 to 40% higher than regional peers, a cost that flows directly into the price of everything from raw materials to supermarket goods. Into this gap stepped Lekki Deep Sea Port, Nigeria's first fully automated, privately financed deep water port, a $1.5 billion project structured as a 45-year public-private partnership. The ownership split tells you everything. The Nigerian Ports Authority holds 5%, Lagos State holds 20%, and private investors hold 75%. on a build-own-operate transfer basis. By the third quarter of 2025, Lekki Port was already driving over 40% of total cargo traffic among Nigerian ports, while still running at only about half its total capacity. That is the good news version of this story. Private capital moving faster than the public sector could, cutting truck turnaround time to under 90 minutes at Lekki versus days at Apapa. But here's what most Nigerian business owners haven't priced in yet. Roads are next. In February 2025, the federal government launched Nigeria's first federal highway toll since 2003 on the Abuja-Akwanga-Lafia-Makurdi corridor, financed by a $460.8 million loan from China's Exim Bank. That toll road is now operated under a 25-year concession by China Harbor Operations and Maintenance Company, a subsidiary of a Chinese state-owned construction group. This is one pilot corridor of 9 planned under Nigeria's Highway Development and Management Initiative, a program that hands 25-year operate and maintain concessions to private partners on federal roads. The next roads scheduled for tolling include the Lagos-Ibadan Expressway, the Second Niger Bridge, and the Abuja-Kano Road, arteries that a huge share of Nigerian import and export cargo physically has to cross. As of early 2026, those tolls haven't gone live yet. Construction is still finishing, but the concessions are already signed. If you run a manufacturing, distribution, or export business anywhere along the Lagos-Ibadan corridor, your inland transport costs are scheduled to change, and the contract that will decide by how much has already been awarded. Nigeria's lesson for infrastructure-dependent business owners? Watch the Infrastructure Concession Regulatory Commission's Gazette, not the news headlines. That's where the real toll schedule shows up first. India is running the most aggressive airport concession program of any major economy on Earth right now, and it matters well beyond air travel. Since 2019, Adani Group has taken control of airports in Ahmedabad, Lucknow, Mangalore, and several other cities, sweeping all 6 airports on offer in that bidding round. India's national monetization pipeline aims to raise the equivalent of well over $100 billion by leasing out existing public assets, highways, railways, power lines, and airports, without selling them outright. A new round covering 11 more airports, including Varanasi and Amritsar, is expected to raise around 47,000 crore rupees in the current fiscal year alone. Adani has publicly said it intends to bid aggressively for all 11 airports in this next round, on top of committing roughly $11 billion in airport infrastructure investment over 5 years. That level of concentration has worried India's own aviation regulators enough that they're now actively considering caps on how many airports a single operator can control. Why should a business owner who never sets foot in an airport care about this? Because air cargo increasingly carries the highest value, most time-sensitive goods in and out of India: electronics, pharmaceuticals, perishables, e-commerce exports. When one operator controls the airports handling that cargo, landing fees, cargo handling charges, and ground service pricing all move together, not independently. The Airports Authority of India has already collected about $4 billion from previous privatization rounds, money that funded real terminal upgrades business travelers and freight operators have visibly benefited from. That's the honest complexity of India's story. Concentrated ownership has coincided with faster, more modern infrastructure, and with less competitive pressure to keep costs down over the long run. For a manufacturer or exporter in India, the practical takeaway is this: know which single operator now controls the airport your goods move through, because their pricing power over you is only growing. Pakistan's story is unfolding in real time, and unlike India's, it isn't optional. It's a condition of a $7 billion IMF bailout approved in 2024. As part of that program, Pakistan committed to privatizing or outsourcing a long list of state-run enterprises, including its airports and its national airline. In December 2025, Pakistan sold 75% of Pakistan International Airlines to a consortium led by Arif Habib Group for $482 million. That deal followed a failed first attempt a year earlier when the government received just a single bid for only $36 million. Pakistan is now moving to outsource management of its three biggest airports, Islamabad, Karachi, and Lahore, under long-term concession or management contracts. Islamabad's privatization, advised by the Asian Development Bank, is targeted for completion during the 2026-27 fiscal year, with Karachi and Lahore's processes beginning immediately after. Officials expect Karachi and Lahore to each draw over $500 million in fresh private investment once outsourced. In January 2026, the government shifted from closed government-to-government talks with the UAE to an open competitive bidding process for all three airports, widening the field of potential international operators. For a Pakistani import-export business, the practical question is blunt. Airport handling fees, cargo storage charges, and ground logistics costs at Karachi and Lahore are all about to be renegotiated by new commercial operators focused on returns, not just throughput. When infrastructure privatization is a bailout condition rather than a domestic policy choice, negotiating leverage sits almost entirely with the lender and the buyer, not with the businesses who will actually pay the new fees. Pakistan's lesson: if your country's infrastructure sales are tied to an IMF program, read the program's structural benchmarks, not just the news about the headline privatization. The fee schedules usually follow within 1 to 2 fiscal years. Brazil offers the most instructive counterexample because it's been running structured, competitive privatization rounds since 2011, longer than almost any other developing economy. Rio de Janeiro's Galeão International Airport, the city's main international gateway, has just been reconceded to Spanish operator INA, finalized across 2025 and 2026. French construction giant Vinci and Brazilian firm CCR have both built major airport and toll road portfolios through these repeated bidding rounds. Notably, CCR recently chose to sell off its airport assets entirely, to refocus purely on toll roads, a sign that even seasoned infrastructure operators are specializing, not diversifying. Brazil's toll road network has followed the identical script: long-dated concessions to private operators, funding new lanes and maintenance the state alone historically couldn't afford. Brazil's lesson for the other three countries in this video: a slow, repeatable, transparent bidding process produces real investment and real competition. But even here, operators eventually consolidate or sell to bigger, more specialized infrastructure funds. The version of this story other developing economies should study isn't Brazil's first concession round. It's what happened by the fifth and sixth round, once investors understood exactly how the game was played. Before we get to what you should actually do, it's worth proving in 30 seconds that this isn't a poor country problem. It's a global one. In the United Kingdom, Thames Water, supplying a quarter of England's population, built up over £19 billion in debt while paying out more than £85 billion to shareholders over 3 decades, and by mid-2026 was on the edge of a government takeover. In Italy, a highway bridge collapse that killed 43 people in 2018 led the state to buy back its own motorway network in 2022, paying €8.2 billion to the very operator blamed for years of underinvestment. And in Panama, a BlackRock-led consortium's $22.8 billion deal for the ports guarding both ends of the Panama Canal is still unresolved as of this recording, tangled in a dispute between the United States, China, and Panama's own courts. Rich countries, poor countries, democracies, authoritarian adjacent systems, infrastructure concession is happening everywhere, at the same time, for the same underlying reason: public budgets can't keep up with the capital these assets need. The only real variable is how much leverage the selling government has when it signs the contract. And Nigeria, India, Pakistan, and Brazil each sit at a different point on that spectrum. Here is exactly what to do with everything you just learned if you run a business that depends on ports, roads, or airports in any of these 4 countries. First, identify which specific terminal, corridor, or concourse your goods physically move through, and find out who currently holds the operating concession, not who used to. Second, check whether that concession has a renewal, review, or fee reset clause coming up in the next 24 months. That's when pricing changes usually get announced. Third, diversify your routing wherever physically possible. A second port option, a second inland route, even at a short-term cost premium, is now a genuine risk management decision, not a luxury. Fourth, build concession-driven cost escalation directly into your pricing and contract models, the same way you already model currency risk or fuel price risk. Fifth, if you're an exporter competing regionally, Nigerian goods against West African peers, Pakistani goods against South Asian peers, remember your competitors are watching the exact same concession calendars, and the first movers will reprice their contracts fastest. 6. Talk to your freight forwarder and customs broker directly about upcoming toll and concession changes. Most of them already know more than they have told you because it isn't in their interest to raise it first. This isn't about avoiding privatized infrastructure. In many cases, as we've seen with Lekki Port and Kansai Airport globally, private operators deliver real, measurable service improvements. It's about not being the last person in your supply chain to know the rules have changed. If you're a policy analyst, journalist, or sovereign wealth advisor watching this, here's where the real story is heading next. Watch India's airport ownership cap debate closely. It's likely to become the template other democracies use when a single operator starts dominating critical logistics infrastructure. Watch Nigeria's Highway Development and Management Initiative rollout on Lagos-Ibadan specifically. It's the first time a genuinely nationally critical trade corridor, not a regional highway, will test Nigeria's reintroduced tolling framework. Watch Pakistan's shift from government to government deals toward open competitive bidding on its airports. It's a meaningful governance signal about how IMF-linked privatizations are being structured going forward. And watch which sovereign and pension funds show up as minority partners in these developing market concessions. That capital flow is often the earliest indicator of how global institutional investors are pricing country risk. The professional-grade version of this story isn't privatization good or bad. It's tracking which specific corridors, terminals, and concessions are moving, and modeling the downstream cost pass-through before it hits headlines. And if you're simply someone living in one of these countries, wondering why the price of everyday goods keeps climbing, even when nothing else in the news seems to explain it, this is one real, provable piece of that puzzle. Port charges, toll fees, and airport costs don't stay with the businesses that pay them first. They move down the chain into the price of food, fuel, electronics, and medicine on the shelf in front of you. Understanding who owns the road doesn't fix the price tag today, but it's the difference between being confused by rising costs and being able to actually ask your representatives the right question about them. Here's the through line across Nigeria, India, Pakistan, and Brazil. The infrastructure you assumed was a fixed, government-guaranteed cost of doing business is becoming a private, negotiated, and increasingly global asset class. That doesn't automatically make it worse. Lekki Port and Kansai Airport prove private capital can genuinely fix what governments couldn't. But it does mean the businesses that track concession contracts as closely as they track exchange rates will outcompete the ones that don't. If this video helped you see a cost risk you hadn't priced in yet, the single most useful thing you can do is send it to one supplier, freight partner, or fellow business owner in your corridor. I read every message about these investigations, and I genuinely like to know which corridor, Lagos-Ibadan, Karachi, Mumbai, or Rio, worries you most for your own business. You can reach me directly on Signal. The username is thebusinessarchitect123.43. If you want a deeper breakdown of a specific port, road, or airport concession affecting your business, subscribe to The Business Architect if you want to keep tracking where the world's hidden money and power actually moves before it shows up on your invoice. I'll see you in the next investigation.